Today we're doing one of those episodes where you can practically feel the ground shifting under an industry. Mortgage and housing are getting pushed and pulled by three big forces at once. Smart tech becoming non-optional, a historic wave of intergenerational wealth moving through homeownership, and a market that's acting steadier on the surface than it feels underneath.
And we're going to tell it like a story, because that's how it's unfolding. Think of it as a few different plot lines that are starting to collide. Lenders trying to stay profitable, families trying to pass down homes, retirees trying to make their budgets work, and policymakers trying to catch up. Let's open with the lender side, because that's where the pressure is loudest. For a while, AI and mortgage felt like a conference buzzword. Something you'd demo, something you'd pilot, something you'd talk about, and then go back to business as usual. That phase is ending. The message coming from industry experts now is basically, this isn't a toy anymore. If you're a lender staring at high costs and complicated operations, AI stops being a fun experiment and turns into leadership homework. And it's not hard to see why. Mortgage operations are full of repetitive tasks, document chaos, verification loops, compliance checks, constant status updates. When volumes shift, staffing can't always flex fast enough. So executives are looking at AI as a lever for speed, consistency, and cost control.
But there's a catch embedded in that word leadership. It's not just buying software. It's deciding where automation is safe, where human judgment must stay, and how to keep borrowers from feeling like they're talking to a wall. Exactly. If you treat AI like a bolt-on gadget, you'll get a bolt-on result. And if your competitor uses it to shrink cycle times and reduce errors while you're still moving files around manually, that gap shows up fast.
Now here's where the second plot line enters. The biggest wealth transfer most of us will witness. The number being thrown around is staggering, about $124 trillion expected to move from older generations to heirs. And a huge part of that story runs through housing.
So mortgage and real estate professionals are being told to start thinking like long-game advisors, not just transaction people. Because when a home changes hands after a death or during a major life transition, that family is going to need guidance. And one of the most direct ways to stay connected to that next generation is estate planning conversations. Not practicing law, obviously, but understanding the process, knowing the pressure points, helping families think ahead, and building relationships with the heirs who might become tomorrow's buyers, refinancers, or sellers. It's such a different mindset. Instead of asking, how do I win this loan, it's, how do I become the person this family trusts through a complex moment? Because that's how you keep clients across generations. Which brings us to the third plot line, politics. Housing issues have become impossible to ignore, and now there's a new bipartisan real estate caucus in Congress. That means lawmakers from both parties are forming a dedicated group to focus on housing policy and challenges tied to the real estate industry.
And when you hear bipartisan these days, you perk up a little because it's rare. It doesn't automatically mean solutions are coming tomorrow, but it does mean real estate is being treated as its own serious lane, not just a side note under the broader economy. So we've got AI becoming a must-have, a massive wealth transfer, pushing the industry toward estate planning awareness, and now Washington organizing itself specifically around real estate issues. That's the big backdrop. Now let's zoom into the part of the market where the human stakes are the most obvious. Retirement. There's a growing distance between what people thought retirement would feel like and what it actually costs. More retirees are discovering they're house-rich, but cash-tight. Expenses rise, income is fixed, and liquidity becomes the daily problem. Not a theoretical problem like, someday we'll optimize our finances. A basic, monthly question. Can we cover the gap?
And that gap is pushing people to look for tools that turn home equity into usable money. Reverse mortgages come up again and again here, especially when the alternative is draining savings too quickly or cutting essentials.
One data point that really sticks. A meaningful share of reverse mortgage applicants are arriving with a budget deficit already. That's not, I'd like more flexibility. That's, I'm short each month.
Now here's the twist in the reverse mortgage story. Private reverse mortgages are having a moment. For the first time, proprietary reverse mortgage volume has surpassed traditional FHA-backed HECMs when you measure total dollar value. That's a big milestone. It suggests the market isn't just growing, it's shifting. Borrowers and originators are looking at alternatives, and private products are taking more of the spotlight, at least by dollar volume.
And it fits the theme of the whole episode. Standard playbooks are getting rewritten. If you're in the business, you can't rely on the usual product mix and assume it stays the same year after year. Speaking of changing playbooks, let's talk about how homeowners are tapping equity more generally. HELOCs used to be the easy answer for a lot of people. But now, with tighter standards, Nearly half of applicants are getting rejected. So originators who want to survive aren't just trying to force-fit everyone into a HELOC anymore. They're pivoting, focusing on solving cash flow problems and matching homeowners to whatever tools actually work in this tighter environment.
It's less, here's the product I sell, and more, here's the problem we need to solve. Which sounds obvious, but it's a real shift in practice, especially when applicants are frustrated and options are narrower.
All right, let's check the pulse of the broader market. Mortgage rates have been bouncing around, but there was a bit of relief. The average 30-year fixed rate pulled back to about 6.45% after touching around 6.5% earlier in the week.
And the reason wasn't some magic housing announcement. Bonds were tracking oil lower. Oil fell after a volatile spike midweek, and that helped rates ease a bit. What's interesting is that this came even as employment data stayed strong and inflation readings generally met expectations. The market still leaned towards slightly lower rates in that moment. And in mortgage, slightly lower can be the difference between a buyer leaning in or backing away.
On the construction side, we got a mixed signal. Housing starts jumped, up about 10.8% in March, which sounds like momentum. But permits fell by roughly the same amount, and permits are a forward-looking clue. If permits slide, the future pipeline can shrink.
So you get this feeling of activity. Now, caution next. Builders can be busy today while quietly getting less confident about what comes after.
Meanwhile, buyers are still showing up. Purchase applications ticked up about 1% last week, even with rates higher than many people want. And compared to last year, activity is meaningfully stronger. People are navigating the spring market anyway.
Prices, though, are behaving differently than they did during the most feverish periods. Home price growth nationally is basically flat to slightly positive in early 2026. But the momentum is fading under the weight of affordability and rates. And then there's an under-discussed force reshaping the market. All cash buyers. Cash deals are now around 28% of existing home sales. That's huge because a cash buyer doesn't touch the mortgage system.
Which means even if home sales are happening, lenders may not feel it the same way. The volume of new loans can stay suppressed because a big chunk of transactions bypass underwriting altogether. So if you're a mortgage leader looking at your pipeline, you might be thinking, why does it feel quieter than the market headlines suggest? Cash is one answer.
Before we wrap, we're going to pivot to a quick health segment because it connects to the same theme we've been talking about all episode. Small changes that actually matter, especially when life is busy and budgets are tight. First, a tiny workout that can have an outsized effect. Research suggests that doing just 4 minutes of short, intense activity spread throughout the day can meaningfully lower the risk of type 2 diabetes. Not 40 minutes, not a perfect gym routine, 4 minutes in bursts. The big idea is that those quick spikes in effort, sprinkled into normal life, can move the needle. Second, water and blood pressure. Drinking enough water is absolutely good for you, but doctors are clear that it's not some instant cure for high blood pressure. Hydration helps your body function well, but it doesn't replace the basics like diet, movement, and overall cardiovascular health.
And third, a surprising one. Over-the-counter saline nasal sprays. New research suggests they might help reduce the risk of catching COVID and could even shorten how long you're sick if you do get it.
It's one of those simple and cheap tools that doesn't sound dramatic, but it's easy to keep around, especially if you're traveling, working around lots of people, or just trying to stack small advantages. So where does that leave us? The headline version is, mortgage and housing are entering a phase where adaptability is the product. AI isn't optional. Client relationships are stretching across generations through estate planning awareness. Reverse mortgages are shifting toward private volume leadership. HELOCs are harder to get, so solutions have to be more creative.
And the market itself is being shaped by rates, permits, and a growing cash buyer presence.
And the story version is, the industry is standing in a doorway. Behind it is the old normal. In front of it is a new reality where technology, demographics, and policy are all moving at the same time. The winners won't just predict the future, they'll build routines and systems that can handle it. That's it for today. If you're in lending, real estate, financial planning, or you're just trying to make sense of where housing is headed, keep an eye on those 3 forces: automation, inheritance, and affordability. They're not separate stories anymore. They're one story. Please like, subscribe, and join us at I Am Healthy Money. Life has its ups and downs, but you're not alone. From 10 to 110, we're in this together, right here, right now. We love ya.
Oh.